As Yana said, my name is Joe Cusick. I was a market maker at the CBOE and also spent over a decade at Options Express help building that platform. I probably talked to or worked with a lot of you that are on this webinar. And I love an opportunity, especially as I was sitting through Cecil's presentation. You know, it's a very engaging presentation, a lot of fun to see different tactics, techniques, and ways to approach the marketplace. And I think this is great that the Trading Pub is putting this on. I'd also be remiss if I didn't also say that this is also part of our partnership with TradeSpoon, which is founded by Vlad Karpel. And TradeSpoon is also an employee of AOS, which does business as Trading Block and MoneyBlock. That's where I'm registered, and we are a registered broker-dealer, FINRA, NFA, and SIPC member, as well as a registered investment advisor. Now, we don't have an affiliation with TradeSpoon, but they are a partner, and with a lot of our partners, we have advertising and marketing arrangements, and a lot of these partners may not be registered as a broker-dealer, such as TradeSpoon, and these arrangements may pay fees or provide other forms of compensation in exchange for marketing. Before I get started and talk about the Condor strategy and talking about how to optimize it and think it through it, and I know a lot of you are looking for insights into premium selling strategies. This is one of the most prominent ones out there. I do have to do this disclaimer. Options do involve risks that are not suitable for all investors. Please read the characteristics and risks of standardized options. You can go to the optionsclearingcorp.com, or you can go to MoneyBlock or TradingBlock.com, or call us at the 800 number right here listed on the screen. Any stock option or future symbol that I'm talking about today is for illustrative and educational purposes only and should not be construed as or intended to portray a recommendation to buy, sell, or hold any security or derivative. All right, so I just saw that you were just talking about pairs towards the tail end. I apologize, I haven't seen all of them. This is like my third webinar of the day, and plus the fact that I'm trading. So I did see that Cecil was talking about some pairs trades, which have really gotten a lot of traction, especially since the CME has put out a lot of information out there about the different types of pairs trades that you can do in the futures world. There's also the currency pairs trades, and with the transparency of being able to see the ticks and having access to these marketplaces, people have had a higher level of confidence, and most importantly, it's that education. This strategy that we're going to talk about here is called a Condor. Now, there's two types of Condors. There's the traditional Condor, right, which is a neutral strategy which can use all calls or all puts that have different strike prices but the same expiration. So if you hear the term Condor, that's what most people in the industry are referring to. When you hear the term Iron Condor, which is the strategy that most people are deploying, that's when you, again, have that neutral sentiment. And basically what you're doing is you're combining two strategies, a bear call spread and a bull put spread. In other words, you're selling out of the money puts and buying an out of the money put against it. You're selling an out of the money call and then buying a further out of the money call against it. You're basically trying to take advantage of a market that's going to stay in between those two strike prices. And you're using a put credit spread and a call credit spread. All right, that's the strategy that we're going to focus on today because that's what's primarily executed. Now, the Condor, as it's traditionally known, this is a neutral strategy where you can actually implement this. For example, if you did a bull call spread a couple weeks ago or a month ago, and you still have a week or two left until expiration, you see that some volatility is coming into the marketplace. You could actually leg in or you could actually put a call credit spread above that bull credit spread you did, and you could actually have this type of contour on. So I'm just laying some nuggets out there, but let's actually dig a little deeper here and talk more about why we're focusing on the Iron Condor and then what it is, and then walk into the construction, the critical elements that you should be thinking about, and I'm going to help you optimize not only entry but also maintenance and things of that nature. So again, an Iron Condor is quite simply where you're combining, as I said, a call spread and a put credit spread, right, into one spread known as an Iron Condor. So here I have a call credit spread. Here I have a put credit spread. You can see if you combine these, you have a large landing area, right? And bottom line is that your convictions are that the stock is not going to go above these strike prices. If it doesn't, you get to keep the net credit for selling these two spreads. Now, the reason why this is why I say this is somewhat conservative is because we have a defined risk, and that's why we wanted to do this, because most people that are trading that are on this particular webcast do not trade naked options. There's a small percentage of us that actually do that. But how can you participate in selling options? Well, you buy the wings. That's why we call it a condor. You buy the wings up here. That's your max risk. And you can only have risk to one side, right? The market is not going to be on both sides of these spreads at expiration. All right. And so the long and short of this is that what you want to do is you want to take a high probability strategy, right? A high probability of success strategy where you're putting up a decent amount of risk capital, but in exchange for a high probability of success. Because I'm just going to be straight with everybody in this room. While it's engaging to look at a lot of these tactics and techniques that are out there, they're very difficult at times, especially when you get either in very directional markets or low implied volatility markets. It just becomes a grind. You're better off doing nothing. But these are the strategies that allow you to continue to participate in a market where you have a higher probability of success. Where success comes in is if you're disciplined enough on sizing and so forth. So what are the critical elements of the condor? Well, the critical elements of a condor are your market outlook is sideways, right? Or slightly more neutral than directional, because there are a plethora of different strategies that you could implement or deploy when you're doing these types of strategies that could have a better risk reward. You wanted to participate in selling options, but you wanted to have limited risk. Well, the condor does that. The iron condor does that. Okay, because you're limited to the risk of the options that you purchased. The reward, well, this is limited as well. Because of the fact that you are selling options, it's limited to the credit you receive. That's one point I want to make to all of you. If you hear the term credit in terms of the options world, that is your maximum profit. If you hear the term debit, that is your maximum risk. Now with credits, your maximum risk, well, if you sell them naked, that's undefined for calls and is defined to 0 for puts. If you buy an option, right, that has a strike price that is below in the terms of puts or above in terms of calls, it's defined to those points. And again, the stock cannot be in both areas at expirations. It's either going to be in between these two strike prices, it's going to be in between these two strike prices, or in between these two strike prices, or above or below these two strike prices. That's the only areas that it can be. Again, profitability for the iron condor, it has to be in between these strikes. And I don't care if it gets within 10, 15 cents of any one of these short strikes, right? It has to, once it's in between those at expiration, you're going to be potentially profitable. Okay? Now, the other thing, too, is in terms of probabilities, yes, if you do the condors based on the criteria that we'll lay out here today, you'll have a higher probability of success, but you're going to take on lower profits. Meaning that if you're doing condors where you're taking in $1 but you have $9 of risk, right? You have a high probability if you structure this correctly, and we'll get into those parameters, but if you structure it correctly, you have a high probability of being successful. In other words, keeping that dollar through that expiration cycle, but you have still a lot of risk capital in play. So first of all, how do I even go in and determine that the condor is the strategy that I want to implement? Well, first and foremost, you got to look at the marketplace you're looking to specifically trade. I don't normally just run in and look at the stock that I want to think about putting a condor on, right? And I'm not looking at vol charts yet. I'm not looking at probabilities. I'm not calculating estimated moves. I've not done any of that. But basically what I want to do is, again, I want to look at the last 6 to 12 months. Now, I am not a technical analyst by trade. I use it to get a picture of the marketplace. All right. As far as I'm concerned, if I could take 2 points and connect them, that's a trend line to me. Once that trend line is broken, and then basically, where it was once resistance is now turning into support. Well, great. Then I draw new trend lines. But the point is that I just look at it so that it confirms what my initial impressions were, or what I'm looking to actually deploy, which is a strategy that is a neutral strategy where I'm trying to take advantage of selling options and taking in yield or premium, right, on my money that I'm putting at risk, that risk capital that we discussed. And I feel good about that risk return on that capital that I'm putting at risk. But this picture is telling me a little bit about what's been going on with the underlying. And so basically for the last 6 months, it's been in this range. In this case, I was looking at IBM. It's basically been between 175 and 195. The reason why I do this is it helps me start to understand about, first of all, is this stock in a trend either up or down? In other words, does it have a bias or is it neutral? In this case, I'm looking at a pretty decent range and it's neutral in my mind, especially if I looked at the overall market. And if I'm looking at IBM, I'm either going to look at the S&Ps or the Dow Jones. And if I look over the same time period, which I don't believe I have that slide in here, but if I did, the Dow has been doing nothing but going up, and the S&Ps have been doing nothing but go up. So this has actually been in a neutral range, albeit a 20-point range, but for 190 or 180 plus dollar stock, that's okay. Now again, once I've gotten perspective or transparency, all right, guys, can you hear me now? Hello? If you can just type in a Y, somebody, if they can hear me, that'd be great. I think it's working. Okay, great. Thanks. Thanks, everybody. I appreciate it. I don't know what the heck happened with that, but I apologize for that. We should be back in play now. All right, so as I was mentioning, once I have a directional bias on the market, both the overall market, and I always have a benchmark, the S&Ps, the Dow Jones, the NASDAQ, whatever it is, I always have some sort of bias. Then I start looking at implied volatility. And the reason why I look at implied volatility, because in that number is that expectation. You've heard the term. It's a Greek term, right? Right? It's that Greek term that basically what's priced into the options price is that expectation of potential movement of the underlying. And the two things that I look at is I look at, first of all, where is IV? I look at IV over a 12-month, a 6-month, and a 3-month period. And the reason why I look at it over that time frame is that what happened 12 months ago may not be pertinent to what's happening today. So while I interpret it as being a low implied volatility over the last 12 months, we may be at moderate or high implied volatility over the last 3 months. So if we had an 11 vol here and all of a sudden it's trading up in a 14, 15 vol here, well, right here it's about a 14 vol, 3 points. Well, that is significant. In other words, I look at that in terms of IV rank. Some of you have heard that term. We've been using it for quite a long time. I've been using it for the last 5 or 6 years, and it's gained some traction. But really what I'm looking for when I am selling options, specifically looking at strategies like Condors or credit spreads, is I like to see that IV rank starting to increase. There's two reasons why. One is that if I have a higher IV rank, in other words, something that's 50% or greater, I'm going to start to see that I'm getting paid for the options that I'm selling, and B, it's also going to get me into some other critical criteria that I want, as far as am I selling options that have a low probability of success while I'm still getting paid? With the 0% IV rank, in other words, it's basically at the same levels as its 52-week low. That's telling me right now that I'm not getting paid a ton as far as in terms of volatility. There's not a heightened expectation of potential movement, violent movement. In other words, whatever the trend is right now, there is no expectation that it's going to violently deviate from that. And the third one is that I'm most likely not going to be able to sell options that are going to have a high probability. And what do I mean by that is a probability of being out of the money of around 80%. Okay? And as I mentioned, probability, right? You can mix that in with your IV percent. So if I have an IV percent that's below 50, but I have an IV that's or a probability of profit of over 50, I could look at that, right? If I'm going to do these types of strategies, specifically the Iron Condor, what I want is to basically have somewhere between no less than a 65 to 70% probability of showing any profit. Because otherwise what I'm doing is, even at 65 or 70%, I'm getting within that one standard deviation move. And while, for example, I haven't seen that happen over the last 6 months a lot in IBM, if it does, I'm going to start getting burned on this. Now, of course, doing the particular Condor that I'm looking at, right, with a probability of 65%, right, I still have the strike prices I'm selling really close to where the underlying is trading. The underlying at the time I was looking at this strategy was trading at 186.50, which was within one standard deviation. I am not a fan. For those of you that are Condor traders, I know that I'm explaining your pain that you've had for basically the last month. For those of you that are looking at this particular strategy, you might be feeling at this stage that you're taking on more risk than it's worth the reward. You may be right, except for the fact that when you look at this, I'm selling this particular Condor. I'm selling the 185, 190 Condor. Basically, that's the middle, right? That's that landing area where I have my maximal profit. So if the underlying stays between 185 and 190, I'm okay. If it goes below that, well, I have protection at 180 on the downside. I have protection on the upside of 195. Now, again, I'm getting paid, though, a pretty decent premium, $330. And if it stays in between 185 and 190, I get to collect all that. If it starts to go above, specifically if it stays above 180.170 or it stays below 193.30, I'm at the bare minimum going to break even or take a small profit. Once it goes above that, I'm going to start getting hit. Specifically, if it goes above the long strike price, 195, I take a 170 hit. 180, 170 hit. So it's a $170 hit, so a 34% loss on the risk capital that I put in play. As long as that constitutes for the total portfolio risk less than maybe 1% or 1.5%, no higher than 3%, folks, you'll be fine. But again, in this environment that we've been in, and for those of you that are strategists that do trade credit strategies of this nature, you're going to find that when you have low IV and you see that your probability starts to get at or close to 50%, you're going to have a position that you probably don't want to be in. And there should be more optimal strategies out there that will fit this current environment. Now, what you could do, though, is you could say, okay, but I'm going to take a step back. How can I increase my probability of success, right, and achieve a higher probability in doing this particular strategy, even in this environment? Well, you can widen the strikes, all right? And when you widen the strikes in this environment, you're doing two things. You're going to get less of a credit, and you're going to have increased risk capital. With these condors, you're receiving a credit, so you realize your profit potential. So in this particular example, I'm going to sell the 175 puts. I'm going to buy sell the $200 calls. So now I've widened that out. As a matter of fact, that is widening it out to the one standard deviation at the time I was looking at this. This was a May Condor in IBM. There's two things that I did. Instead of having the probability of any profit being 65%, I've increased my probability of any profit to 77%, or 76.77%, right? That means that basically I have about a 22% probability that these particular strategies could work against me. Now I'm sleeping better at night. I now know that I have the probabilities in my favor. The one thing that I do have to deal with is that because I have a higher probability of success, I've taken on obviously more risk. That's what happens when you get higher probability strategies. You're going to have to give up something, and in this case, I'm giving up the fact that I have increased, or I'm increasing risk, right? I'm giving up that luxury of saying I had a nice profit built into this, but higher probability success. And in an environment where IV percent was low, and there's really no catalyst that's going to move this, I'm willing to take that on. Also, I sized this appropriately. So I sized it to a point that, yes, I could take a 78% hit on the risk capital, my potential reward versus risk, but that's less than 1.5 to 3% of portfolio risk. If you stick within those guidelines, folks, you're going to find that you're going to have great success with these particular strategies. So let's talk about what ifs. If the stock moves past 205, I reach my maximum loss. If it remains between 173.93 and 201, I'm going to have my maximum profit. If it moves down past 170, I'm going to recognize my maximum loss. Now that's the ultimate at expiration. I'm going to give you a nugget here, folks. After all the years of trading these types of strategies, after doing a few studies, and I know that there are other individuals that have been talking about this for quite a bit of time, I have been out talking about when do I take profits, and specifically in these particular types of strategies, iron condors. I'm going to tell you right now, if I sold this particular strategy, and I'm actually going to go, I'm sorry, I don't know how to go back on there. Here we go. If I sold this strategy for $1.07, okay, I'm going to start taking profits, not at expiration. In other words, I'm not going to wait until expiration. When this particular strategy is trading for 50 cents, in other words, the market has stayed in between these strike prices, time decay has kicked in on my short options, and now the spread is trading for, this iron condor is trading for 50 cents, I'm going to pull it off. That's a little nugget from me to you. I have found that pulling off these strategies at 50 cents, at 50% profit levels has been the most optimal level. I've looked at it both using ETFs, index options. I've looked at it using some of the high flyer equity options, and I've found that is an optimal level. Again, waiting to expiration, the reason why I don't like to wait to expiration is because it doesn't allow me to redeploy that risk capital out to what I would find as higher probability opportunities. That's one reason why. The next reason why is that if I wait until 75 or 100% profit, I found that with market conditions at this juncture, being at a point where things like you'll hear terms like capitulation or complacency. If you start hearing terms like that, or you start seeing that there's too much complacency and whatnot, I start to see nervousness that comes up, and I don't want to sit here and manage a trade that was once a winner and now is either a small loser. If it does become a loser, all right, I don't wait until maximum loss. If I sold this strategy for $1, right, and my max risk in this case, because the difference between the strike prices minus the premium is my risk, so it's $4, I pull this particular strategy off, not at max loss. I don't wait until expiration, If it's trading at 200% the credit I receive, I pull it off. I've historically done that. So I've given you two risk management techniques or position management techniques that I think you can take to the bank. And that is you take your profits at 50% and you cut your losses at 200% of your max risk for these credit strategies. So in other words, if 2% of your max profit, 200%. So again, like I said, if I sold it for $1, I'm cutting this at $3. That's how I've utilized my risk management tactics and techniques after I've done all the other setup components. That has worked well for me. It's gotten me out of really cruddy trades, and it's captured profits in trades where a lot of times I wouldn't have captured those because I would wait until expiration. Another thing that you should be thinking, let's say that the market does start to move. In this case, let's say that the market does start to go to the upside. I don't look at the upside calls, the call credit spread, as the side that I have to manage. I manage the untested side. In other words, I look at the put spread in that. So if the stock goes from 186 to 195, and as you're typing the questions, I'll answer them when I get an opportunity. But as, for example, and again, I'll go over these a little bit more. I manage the untested side. So if the stock goes from 190 to 186 to 190 or 195, am I looking at that 200, 205 call spread? No, I am not, or the 200, 210 call spread, whatever it is. I am not. I'm looking at the 175, 170 put spread because that's the side that I have some profit built into it. I look at it and go, all right, do I roll this up to the 180, 175? In other words, first of all, am I getting paid to do that? Second of all, with the underlying trading at 190, most likely not. At 195, it could be a good opportunity to capture some more profit. And I might do the 185, 175 and roll up. The other thing is that as I get, if I did hold it to expiration, which some of you will, you can actually go in and you can go in and say, all right, well, I have a nickel left or a dime left in these short options. I'm going to sit and wait. Don't. Cover that short strike that's closest to where the market is trading. It's absolutely crazy to think that the stock is going to work totally in your favor at that juncture. Yes, probably 8 times out of 10. It will, maybe even 9 times out of 10. But all it takes is that 1 or 2 times where all of a sudden the market does something goofy and it moves against you. And I know that a lot of you are nodding your heads going, yes, I've done this. And especially those of you that are going to try to deploy this with weekly. So I'm going to answer that question right now. If you're trying to do this with weekly options, you're going to have a hard time. And the reason why I say that is, and I don't trade weekly options. So this is coming from somebody that has tried using weekly options, but has had, I haven't had a ton of success, and a lot of it has to do with obviously the low implied volatility market. And I found that weekly options, really the benefit of using weekly options is more in the where you have a binary event, right? You have a binary event and you have a directional bias. And even if you don't have don't have a directional bias, you have some sort of binary event like earnings. If you're doing these weekly condors, you're going to find 2 things. One is you're going to be selling that are within 1 standard deviation. In other words, they only have you only have about maybe 60 to 65% probability of being successful. And the problem with weekly options is you have very little time to be right. So if all of a sudden the market gets directionally biased, you don't have time for the market to either pull back on the case of the call spread or bounce in the case of the put spread, right? In other words, it correlates back to the mean. It just doesn't do that. you don't have enough time. So that's why I don't like using this strategy or utilize weekly options for credit strategies. It's very difficult for me because I have such little time. As a matter of fact, when I'm looking at these particular strategies, one thing, and this goes out more towards the trade setup, I typically don't look at condors unless they have at least 45 to 50 days until expiration. Two reasons. One is it gives me more time premium. That's more beneficial when you're selling options. The second thing is it gives me more time to be right. If for whatever reason, between the time I put it on, which may be 50 or 45 days before expiration, if all of a sudden the market gets directional, it has more time to deviate back to the mean, right? So a couple example. I was trading Michael Kors a week ago. Michael Kors was trading basically right around the mid 80s, almost in the 90s. But it was it was the mid 80s, almost in the 90s. Earnings came out. It popped and then it pulled back. I had some credit strategies on there taking advantage of what was an IV percentile that was over 50%. Well, initially, and I was doing June options, initially that strategy was in the money working against me. Then the market deviated back. Same thing with Gilead. Same thing with a couple other opportunities that I had out there. Because I had more time premium in there and I did it at a longer time frame. Now I don't extend past 45, 50 days, top 60 days when I'm doing premium selling strategies because the decay factor is just not going to kick in enough for me. Another thing too is when you do these out of the money strategies and you do them 60, 50, 45 days out, you can start looking at potentially pulling profits at around that 18 to 15 day mark. That's when you're really going to be looking at these strategies and saying, from a trade management side, I'm going to look, do I have a 50 or 75% target profit, right? If I do, you can pull it, right? I do not suggest using stops on these spreads, right? I do not, and thank you, Neil, I do not suggest that you make adjustments to the challenge side. I always am looking at the unchallenged side and seeing if there's an opportunity to either roll up and put on a bigger credit or adding to the credit I received, which will offset any potential loss, right? I do not, now Neil is also saying, well, could you mitigate it by actually flying it off? Neil, then you're opening up Pandora's box. That then is a targeted strategy where you want to go out at the body of the, which again, and I just, no, Neil, I wouldn't fly that off either. It's just, it gets too messy. Basically, I look at the untested side and I size it appropriately first and foremost, so that I know that even if it goes through my through one side of the trade and it goes through my protection, right, that wing, that I know what my maximum risk is, and it's no more than 1 to 3.5% of the total portfolio risk. Usually, it's going to be a lot less than that, but it's 1 to 3%. Okay. Whether it's the percentage buying power, cash available, or size portion of the portfolio. All right, that's what I use, Neil. I don't like to use a lot of adjustments. It just gets messy. All right, well, I thought, and the way I structured this was for about 30, 35-minute discussion. So I want to open this up for questions. And you know what, guys? Krieg, I'm not going to... Someone's asking me to recommend a broker. Well, I work for one. It's called Trading Block and MoneyBlock. If you actually want to work with an advisor who could work not only with your portfolio, but also advise you on some stuff, come talk to me. You can email me at support@moneyblock. That comes directly to me. If you're looking for a new platform, I know there's a lot of transition out there. There was a deal announced last week. Option House and Trade Monster are now merged. They were purchased by another entity. Bottom line is that if you're looking for a new home, whether it's because of cost or ability to trade these transactions. Yes, I worked at Options Express. They were bought for Charles Schwab. I spent 12 years at that firm. A lot of blood, sweat, and tears went into that. I'll tell you this: one thing that you will have potential difficulty with is you may not be able to trade this strategy in accounts like IRAs. In other words, non-taxable accounts, trusts, things of that nature. If you don't have it in your articles, obviously you won't be able to do it. But even if you do, they may not let you do it. And you want to be able to have that interface so you can point, click, and be able to do that. And as things go on that side of the fence, things have been changing, especially when I was on my way out. So, please take an opportunity to take a look at us. What's the correlation between stock price and potential profit? James is asking that. Well, basically, when you look at your terms of probability, James, that basically where the stock's trading and the strikes you are choosing as far as the is going to be more of a determinant of potential profit, right? And so the strike price of the option and the proximity of that strike price to where the stock is trading. We used to say back in the day before we built out all of these great tools that will calculate, now using these big models, whether it's a tweak version of a binomial model or some other proprietary model to calculate probabilities. But the long and short of it is, James, we used to use the delta, either of the net position, but specifically of the strike price that has the most risk. But bottom line is that helps us understand more how to the probability of success of that potential trade at the time of the trade. Now that does change as the underlying market moves, as implied volatility could potentially change, and days to expiration. Yeah, and I'm sorry, I'm surprised, Krieg, you didn't hear that. Yep, it's big. It's a decent-sized merger. Weekly options have high theta, so why not take advantage of this factor for a delta-neutral Condor strategy? George, they do not have a lot of theta. As a matter of fact, George, weekly options are all is primarily a delta play. This is a delta and vega play. There is not a lot of time. With 7 days left, there is not a lot of time premium in those options. If you look at even at the monthly options, look at the options that are expiring next weekend that are in the monthly cycle. Remember, you look at that graph. I'm actually going to see if I have a drawing tool available here. I think I do. But if you actually look at a graph here, maybe I don't. But the traditional time decay goes something like this. If it goes something like this, right? If you see that right here, right in this area right here, that's like 7 days. There's not a lot of time left in that. All right, I'm just doing this. This is a horrible way of looking at it. Now that's for at the money. If you have out of the money options, as a matter of fact, your time decay factor looks like this. So again, when you get to this area, right, of 7 days, that time factor, or in other words, that theta that you thought you were taking in, George, it's not there. So that's why I have a hard time utilizing these types of strategies or utilizing the these factors when I am. Craig, I'm not answering how much the Nigerian brothers are worth. I have no idea. Ask Peter John. All right, that's for them to answer. How do I feel about binary options? I have not traded them. I know there's actually an exchange out there. They're interesting opportunities. They are pretty focused bets. I think that playing binary events, you can use options in a pretty in a risk averse way. Not a risk, totally risk averse, but you could do it where you're the risk parameters that you're putting out there are defined. Okay. And so if you and again, I have never used the pure binary options. I know Nadex is an exchange out there. I haven't used those. Also, you're seeing up here, our partners at TradeSpoon do have a special offer. I believe that Yana put a link out. Vlad asked if that was out in the TradeSpoon group, who is our partners in this event. I can't speak to the particular offer that's up there. If you have any questions about it, you can click the link and you can get more information on that, and then you can go to either their live chat or you can go to the TradeSpoon email address, which is info@tradespoon, to get more information on that. Also, if you want to open up an account, either a trading block on the self-directed side, you can go to tradingblock.com, or if you want to come and talk to me more about what are the opportunities of working with an advisor, email me at support@moneyblock.com or go to moneyblock.com. So James is asking a high-price stock versus a lower-price stock for an iron Condor, given VIX is equal. James, obviously the price of the stock, with the higher price stocks, you have the potential of having higher volatility, especially, but you also have the potential for it having more liquidity. Really, the price is not the matter to me. What matters to me is the IV percent rank. What matters to me is, do I have a strong sense of the overall market and that underlying I'm looking at as far as what it has been doing. Then I look at the option pricing, and specifically, there's one thing that I didn't do, which is a calculation that a lot of our platforms do now. But I do a quick check where I look at the at-the-money straddle and the first strikeout strangle. I add up the offers on that, divide it by 2. That gives me a 50% probability of moving up or down by that amount. And so, James, basically, I don't care what the price of the stock is. What I do is I look at IV percent rank, and I see, okay, if it's high, then I'm thinking that there's a potential to potentially do some sort of either a directional strategy if I have a directional bias, or it's an opportunity where I don't have a directional bias, but I'm looking to sell options because there is heightened implied vol. Then that's how I approach it, and then I go through my what I know would be optimal types of strategies. So, whether it's Apple at almost $100 or whether it's Microsoft at, I don't know where it's trading right now, but let's say $30 or $40, I don't care about the price of the stock. But if Microsoft has an IV percent rank of 60%, I'm going to look at potentially looking at, are there any and the stock looks like it could have a range that will stay within the short strike prices for Condor. I'm going to look at that versus Apple, who might have an IV rank of 15%. And yes, it's been trending to the upside, so it seems very directionally biased post-split. It was on the top of mind. So I don't care about the price of that. I'm looking at those other components. Boris is asking, I've heard that when you sell an option, you have an option assigned. What happened then? As a matter of fact, right before I did this particular event, I did an expiration discussion. We do have a video on our trading block side. If you go to the Learn section, there's a great video on Boris, that exact issue. What happens if you're assigned? Basically, what happens is that when you're assigned, so for example, on our example that we were showing before, which is let's say that I get assigned on the $200 calls. What do? Well, if the stock is above the 205 calls, those are going to be automatically exercised, and you basically say, okay, I'm covered. My short stock is being covered by my long stock, and you're going to take your maximum hit. If it's in between, right? If it's in between these strike prices and it's before expiration, you can look to do two things. One is that you could do what's called same-day substitution, which means that you could buy back the stock and you could sell the 205 calls. Now, why would I do that? Because if there is time before expiration, there's probably going to be some extrinsic or time value in these 205 calls. This gives you an opportunity to take advantage of that, take off a little bit less of the pain because you're going to be taking a loss most likely at that point. And you sell those back to the marketplace, then you're out. Now, you do have this other side that's working, so you need to pay attention to that. But, Boris, that's what basically would happen. If it's before expiration, you have same-day substitution. If it's after expiration, in other words, you waited until 2:59 Central Time or 3:59 Eastern Time or 12:59 West Coast Time, and I'm not even going to go over Mountain Time, which would be 1:59. But the point is, you wait until the last minute of that expiration day, and you go, "Oh my gosh, the stock is trading at 201." Bottom line is that you will be assigned, because once this call is more than 1 cent in the money, you are going to be assigned. Now, yes, there is a hint of possibility of not, but once it's more than 1 or 2 or 10 cents in the money, you're going to be assigned. Don't wait that long. That's why I said have a trade management plan. That's why when you're doing this, don't wait until the last minute. Cease taking profits if it gets into that 50 to 75% level. If, in fact, before expiration it gets into that 200% level where it has gone against you, right? You collected $1 for this particular strategy, and this particular strategy is now trading for $3. Cut your losses. Get out. Do not wait until it gets in between these numbers. The one thing that you do know is that if the stock's trading at 201.07, right, to the upside, or 173.93 to the downside, and it's very close to expiration, you're most likely going to be able to get out at close to or a little over break even. So take advantage of that. And when you look at it from this perspective, before you even push the trade button, you're going to be able to manage that for us. Shirley's asking if you have limited capital to invest, right? Like $500 in a Condor. What would you recommend? Well, first of all, Shirley, if you only have $500 in your account, you're going to be hard pressed to say that you're going to have enough investment capital to trade options. I mean, I'm just going to be frank. When I got into the retail side of the business, it was a struggle to say that anyone was going to make significant strides having less than $10,000 in their account when they're trading options. Now, surely what I would say is that I think that you are going to have to be very strategic. Doing condors may not be in your best interest, because if you're selling, for this particular example, if you did this condor, right, that has about a 77% probability of being worthless at expiration, the hard part is that for the $1 that you could make on it, you're taking $4 of risk, which is basically almost your whole entire account. I struggle with that. You could, instead of taking $1's risk, you could look at doing the 180, 185 call spread, right, a deep in the money call spread, or the 200 or the 205, 200 put spread, and maybe buying that for $1 or $2 versus taking on $4 of risk on this credit strategy. There might be more optimal strategies that will fit what your, in this case, your restrictions are as far as the amount of risk capital you have. And again, Shirley, I would also be remiss to say, if this is money that you need to live on over the next 5 years, don't waste it. Take the time to use virtual trade components so that you develop the discipline, so that when you do get enough risk capital, like the $5,000 or $10,000, that you now have the discipline to do it. Chuck, our platform, we're working on doing probability percentiles as it's, but right now you'll have to use the delta. Someone's asking, where do I reside? I am in Chicago. As a matter of fact, our office is in the same office as Nadex. We're right here down in the middle of the financial district. Jack, does the trading block accept accounts outside of U.S.? We do not market taking accounts outside of the U.S. No, we don't. And Shirley, yeah, definitely. You know, for those of you that have limited risk capital, I would take more of a conservative approach. I mean, Obviously, I do like, looking at condors and saying, you know what, if I have a 75, 80, 85% probability of being successful, yeah, that could be a nice exercise. But if the market is either in a directional bias, for example, we've been in a market that's been going to the upside, or it has the potential, when you see VIX start to move and it starts to move to the upside, and then all of a sudden you have some uncertainty. Having those types of strategies on at that point in time may not be the most optimal. That's why I throw out, Shirley, the whole components of, if you can't sell an option, and for you, if you're going to do this particular strategy, one rule of thumb is that if you're selling strike prices that are 1.5 standard deviations or less, right, inside, or in other words, I'll make it very clear to you guys, if you're selling options that have greater than a 20 delta on these particular strategies, you're within basically 1 standard deviation, right? So if you don't have those tools or applications built in, if you're selling basically 20, 25 delta options, you're now starting to get within, or 30 or 40 delta options, you're now within 1 standard deviation. And again, if you ever need to get a hold of me, support at MoneyBlock, that comes directly to me. And all right. Are there any other questions? I'm scared to try to see try to bring up any other interface here because I don't want Omnovia to crash. All right, folks, again, explain deviation again. Tony's asking that. All right, Tony, I'm going to do a pathetic drawing here. What is deviation? So if you think about it in terms of this bell-shaped curve, we all remember that from statistics, right? You have your mean right here. That's the middle, okay? Basically what a standard deviation is it deviates from this mean. And 1 standard deviation is basically saying that it's giving you 34%, and I don't know if I should even write, it won't even make sense, but it's 34% of the price action from this middle price, this middle point, to this lower end, and 34% from this middle price to this upper end. That's giving you 68% of the price action, right? That's 1 standard deviation on this standard bell-shaped curve, okay? So that's what I mean by deviation. So, for example, let's say that the stock was trading, as we said, at 186, right? Right here. If I look at selling the 175 puts here and the $200 calls here, those particular options are 1 standard deviation out of the money. In other words, it's 34% of the price action has been accounted for, right? And 1 total standard deviation is 68%. That's taking in the downside and the upside. That's 68%. So that's correct. Chuck, 1 standard deviation is 68%. 2 standard deviations is out here, which is 95%. And then 3 standard deviations is way out here, and those are typically called those black swan events. But the bottom line is that if I'm selling this call here and this put here, which is 1 standard deviation away from the mean, right? That means that this call has only about a 16% probability of being in the money expiration. This put has a 16%. If I do 2 standard deviations, that means that this put has 5% probability of being in the money, and this has 5%. This call has 5%. And if I do 3 standard deviations, which is basically 99.7%, and again, thank you, Chuck, for those precise numbers, that means that I have less than 1% probability of being in the money at expiration, either at the top or the bottom. Now, again, long-term capital taught us all that while you have these perfect standard deviations, right, the math works, it doesn't mean that things can't get irrational, right? And so that's why I say sizing is paramount. Yeah, I may only have a 16% probability that this thing might work against me, and an 84% probability that's going to work for me, but I don't care. The reason why I don't care is because it could, and if it does, I want to make sure that it doesn't take out more than it. I don't have more portfolio risk than 1 to 3%. Tony, I hope that answered your question, and Chuck, I appreciate your typing that in for me. And thanks, everybody. I know this is, some of you might have been a very basic approach. Yes, I didn't go into a ton of technical analysis because I don't use a ton of it. I do use things like simple moving averages. I do use things like Fibonacci retracements and extensions, not ad nauseum. And really what I do is I let the option prices give me, and volatility give me the perspective I need as far as strategy selection and market sentiment. I mean, it really it helps with that. You know, because I can look at the picture of a chart, and that's giving me past price history. But I haven't met a technician that can show me a forecast. That's built into any type of study that I put in of potential movement in the future. The only product I know that has that is an option, and that's why I use the option pricing. And Chuck, yeah, definitely. Thank you very much, and I look forward to talking to you. And folks, like I said, I am here, and I definitely want to, you email me at support@MoneyBlock. Also, at TradeSpoon, again, our partners over at TradeSpoon, you can get in contact with them at info@tradespoon.com, and I know that Vlad and team would be more than happy to answer any questions or considerations about that. We are three separate entities, with Trading Block, Money Block, AOS, separate from TradeSpoon, but they are a valued partner. So I'd be remiss not to discuss that.